While the average retail investor stares at their screen with sweaty palms, paralyzed by the latest 5% dip, a silent revolution is occurring beneath the surface of the global financial markets. We call it the institutional siphon. This phenomenon represents a massive divergence in sentiment, where the casual trader is exiting out of fear, while the world's largest asset managers are quietly activating their systematic investment plans. This isn't just about price action, it is about the structural shifting of supply from weak hands into the cold storage of titans like BlackRock and Fidelity. As the retail fear and greed index hovers in neutral, the quiet humming of high-frequency institutional buying creates an invisible foundation that few The mechanics of this siphon are driven by the recent approval and integration of Bitcoin and XRP spot ETFs, which serve as the primary conduits for this capital migration. Unlike the retail pumps of 2017, this inflow is programmatic, disciplined, and relentless. These ETFs are creating a liquidity floor that essentially prevents the catastrophic drawdowns seen in previous cycles. Every time the price dips toward the $68,000 zone, these institutional engines kick into high gear, absorbing the sell pressure with surgical precision. We are witnessing the professionalization of crypto as an asset class, where traditional bank towers are no longer fighting the blockchain, but are instead building the pipes to own its most valuable. A fascinating gap has emerged between public perception and private action. While social media sentiment remains tepid and focused on short-term volatility, institutional SIP-based investing, systematic investment plans, is currently at an all-time high. These large-scale players do not care about the noise of a single Tuesday afternoon. They operate on decades-long time horizons, using automated algorithms to purchase assets at predetermined intervals. This set-and-forget approach by the world's wealthiest institutions is effectively drying up the available liquid supply on exchanges. When retail finally realizes the scarcity has increased, they will find themselves competing with multi-trillion-dollar entities for the remaining fragments of digital gold. Let us move into the technical heart of the matter, focusing on the critical support level between $68,000 and $70,000. This range is not just a psychological number, it is a heavy-duty structural zone where massive institutional order blocks are currently clustered. Technical analysis reveals that this area acted as a major resistance point for months, and through the principle of polarity, it is now transformed into a formidable floor. Traders watching the candle closes on the daily and weekly timeframes will notice a recurring pattern of long lower wicks in this region. This signal indicates that whenever the price ventures into this territory, the institutional siphon accelerates, instantly gobbling up the available liquidity. Diving deeper into the order book heat maps, we see a wall of buying interest that makes the current volatility look like noise. The depth of the market at the $68,000 mark suggests that for the price to drop further, it would require a black swan event of unprecedented proportions. Institutional bidders have effectively placed a safety net under the market, creating a localized bottom that defies traditional retail sentiment analysis. This concentration of capital at specific price points is a clear sign of sophisticated accumulation. By analyzing these heat maps, we can see the footprint of the whales, proving that the institutional siphon is a tangible, measurable force that dictates the rhythm of the entire crypto ecosystem. While Bitcoin anchors the market, Ethereum is attempting its own strategic recovery, targeting the $2,046 pivot point. This specific level is crucial for ETH's long-term bullish structure. As the institutional siphon pulls capital into the ecosystem, Ethereum benefits from the spillover effect, as it remains the primary platform for decentralized finance and smart contracts. The recovery toward 2046 is more than just a price target. It represents a return to a high-volume node where major players are looking to re-establish their long positions. If Ethereum can flip this level into support, it clears the path for a massive rally that could finally see it outperforming Bitcoin in the coming quarters of the cycle. To understand the strength of this recovery, we must compare the crypto market against the broader macro backdrop, specifically the US dollar index or DXY. Usually, a strong dollar spells disaster for risk assets, but we are entering a unique period of relative strength. Bitcoin and Ethereum are showing resilience even when the dollar attempts to rally, suggesting that the institutional siphon is decoupling crypto from traditional correlations. This decoupling is a major milestone for the maturity of the asset class. As the DXY loses its absolute power over crypto pricing, the technical floors we identified at $68,000 become even more significant. We are moving into a regime where internal crypto fundamentals find. Transitioning from the established giants, we must look at the most potent catalyst on the horizon, Solana's Alpenglow Upgrade. For a long time, critics pointed to Solana's network stability as its Achilles heel, but those days are rapidly coming to an end. Alpenglow is not just a minor patch, it is a total overhaul of the consensus mechanism designed to bring the network out of its beta phase and into a state of institutional-grade robustness. This upgrade targets the core bottlenecks that caused past outages, positioning Solana as the undisputed leader in high-throughput blockchain technology. As we look toward the second half of 2026, the market is beginning to price in the massive implications of this technological leap forward. The mechanics of the Alpenglow upgrade involve a revolutionary approach to how nodes communicate and validate transactions across the global network. By optimizing data propagation and reducing the latency of the consensus layer, Solana will be able to handle hundreds of thousands of transactions per second with near-instant finality. This isn't just about speed, it's about reliability for the world's financial systems. When institutional players look for a network to host tokenized assets and global payment rails, they require the stability that Alpenglow promises. This consensus upgrade effectively removes the final barrier for massive corporate adoption, turning Solana into a killer catalyst that could reshape the hierarchy of the top 10 cryptocurrencies. Why is the second half of 2026 the specific target for the Solana moonshot? It is because the full integration of Alpenglow, combined with the maturation of the developer ecosystem, will reach a critical mass by then. Major financial institutions typically require 18 to 24 months of testing before they migrate significant capital onto a new infrastructure. By H2 2026, we expect the first wave of institutional-grade dApps to launch on the stabilized Solana mainnet. This timeline perfectly aligns with the broader market cycle, creating a perfect storm of technological readiness and liquidity inflows. Investors who understand this roadmap are positioning themselves now, long before the main. Navigating this landscape requires a disciplined portfolio strategy, focusing on the top 10 cryptocurrencies for stable, long-term growth. At the top, Bitcoin and Ethereum remain the blue chips that provide the foundation for any serious trader. However, the middle of the pack is where the real opportunities lie. Projects like Solana, XRP, and Cardano are vying for dominance, each offering a unique value proposition to the institutional Siphon. By ranking these assets based on their developer activity, institutional partnerships, and technical roadmaps, we can construct a balanced portfolio that captures the growth of the entire sector while minimizing the risks of individual failures. Diversification within the top 10 is the key to surviving the volatility. As we conclude this deep dive, remember that the most successful investors are those who can see the institutional Siphon while everyone else is blinded by price swings. The strategy for the next 24 months is clear. Watch the support zones at 68,000, track the progress of the Alpenglow upgrade, and maintain a diversified core of top-tier assets. The transfer of wealth from retail hands to institutional vaults is a once-in-a-generation event. By understanding the underlying macro forces and technical structures, you can align your portfolio with the big money rather than fighting against it. Stay focused, stay disciplined, and always look for the liquidity floors that the world's most powerful institutions